If SIBOR is revamped, it may see home loan rates change more frequently in the future. This is according to analysts who said that these enhancements, if implemented, will cause the benchmark to be more sensitive to market conditions. The proposal to enhance the benchmark, which is used as reference for mortgages, was announced last week, and Dylan Low explains.
It's the rate at which banks in Singapore lend to each other, but it's also a rate financial institutions commonly use as a benchmark for setting home loan conditions. The Singapore Interbank Offered Rate, or SIBOR, is set to undergo some changes. These include the methodology used to calculate the rate and a plan to expand the markets used to reference SIBOR.
With the new system, it's likely there will be much more volatility because the rates will be set according to movements in the market, and daily fluctuations could be greater. Therefore, both on the upside and downside, you may see more volatility, and that could flow through to the individual rates that consumers are seeing in terms of their own borrowing costs.
For those servicing home loans, it means interest rates may fluctuate more frequently depending on market conditions. The changes to SIBOR are meant to increase transparency. In 2013, Singapore Central Bank censured 20 banks, saying 133 traders had tried to manipulate rates, including the SIBOR. Analysts say the SIBOR reform can be a double-edged sword. While its integrity will be enhanced, any movements will also be felt more keenly.
The reforms will more quickly reflect rising interest rates, but this is really driven by the global trend. Only thing the reforms is going to cause the transmission of that into SIBOR much sooner. What that means for consumers and specifically for home loan borrowers is that they might find the upward adjustment to their rates, home loan rates coming through sooner.
Analysts expect that borrowing interest rates can only rise going forward. The SIBOR tends to move along with the United States Federal Reserve funds rate, which is set to head north from historically low levels.
So one option that you may want to consider if you're taking up a home loan is to go for a fixed-term package, which locks in interest rates for a defined period, like 3 years for instance. This is compared to a package pegged to floating interest rates, which can change from month to month.